For 80 years, the US dollar has been the most powerful financial instrument on Earth. Every oil trade, every international contract, every central bank reserve, all of it denominated in dollars. That system is cracking, not collapsing, but cracking in ways that will reshape global finance over the next decade and that most investors are completely unprepared for. Today we explain what the petrodollar is, why it is under threat, and what it means for your portfolio. Chapter 1. How the dollar became the world's currency. The story starts in 1944 at Bretton Woods, a conference where 44 allied nations agreed the US dollar would be the world's reserve currency. America had won the war. It had the strongest economy. It had the most gold. It made sense. In 1971, Nixon ended the dollar's convertibility to gold. The Nixon shock. The dollar was no longer backed by anything physical. It was backed by trust. But here is what kept the system intact. In 1973, the US struck a deal with Saudi Arabia. The Saudis would price all oil exports exclusively in US dollars. In exchange, the US would provide military protection. Every other OPEC nation followed. This created the petrodollar system. If you wanted to buy oil, which every economy on Earth needs, you needed US dollars first. It was the most elegant financial arrangement in modern history. Chapter 2. Why it is under threat. Three things are happening simultaneously. First, Saudi Arabia is breaking ranks. In 2023, Saudi Arabia announced it would accept Chinese yuan for oil payments. The first crack in the petrodollar wall in 50 years. In 2024, Saudi Arabia formally joined the Shanghai Cooperation Organization. The country that built the petrodollar system is hedging its bets. Second, BRICS is expanding. BRICS now includes Egypt, Ethiopia, Iran, Saudi Arabia, and the UAE after the 2024 expansion. These countries represent roughly 40% of global GDP and over half of global oil production. They're actively building payment systems that bypass the US dollar. Third, US sanctions overreach. When the US froze $300 billion in Russian central bank reserves in 2022, it sent a message to every country on Earth. If you hold your reserves in dollars, the US can freeze them. China, which holds over $3 trillion in foreign reserves, took note immediately. The weaponization of the dollar accelerated de-dollarization faster than anything else could have. Chapter 3. What de-dollarization actually means. Most coverage gets this wrong. De-dollarization does not mean the dollar collapses overnight. It is a gradual reduction in the dollar's share of global trade, reserves, and financial transactions. And that process is already underway. The dollar's share of global central bank reserves has fallen from 71% in 2001 to roughly 58% today. Still dominant. But the direction is clear. India is buying Russian oil in rupees. China and Brazil are settling trade in yuan. The Gulf states are experimenting with digital currencies that bypass the dollar system entirely. None of this kills the dollar, but it reduces the structural demand for dollars that has underpinned US monetary policy for 50 years. Chapter 4. Why this matters. The petrodollar system gave the United States what French economist Valéry Giscard d'Estaing called the exorbitant privilege. Because everyone needs dollars, the US can run large deficits and borrow at lower interest rates than any other country. The rest of the world effectively subsidizes US spending by holding dollar reserves. US national debt is now over $36 trillion. Interest payments are approaching $1 trillion per year. This is only sustainable as long as there is sufficient global demand for US treasuries, which requires sufficient global demand for dollars. If de-dollarization accelerates, demand for US treasuries falls. Interest rates rise. The cost of US debt explodes. The math that has made American deficits sustainable for decades starts to break down. This is not a near-term crisis, but it is a structural shift that compounds quietly, the same way compound interest works in reverse. Chapter 5. The bull case for the dollar. The dollar is not going anywhere quickly. When there is a global crisis, 2008, 2020, 2022, investors flee to dollars, not away from them. The dollar strengthened in every major global crisis of the last 20 years. There is no credible alternative. The euro is structurally fragile. The yuan is not freely convertible. Gold is illiquid. Crypto is too volatile. And the US military, the ultimate guarantor of the dollar system, remains without peer. Chapter 6. What to do. 3 ways to position for a world where dollar dominance is slowly eroding. 1. Own gold. Central banks, particularly China, Russia, India, and Poland, have been buying gold at record rates. Gold hit record highs in 2024 and 2025, and this is not coincidence. Central banks are diversifying away from dollar reserves into the one asset no government can freeze. 2. Consider commodity exposure. In a world where oil is increasingly priced in multiple currencies, commodity producers become less dependent on dollar strength. Energy companies, mining stocks, and commodity ETFs are a natural hedge against dollar erosion. 3. Do not overreact. The dollar losing reserve status gradually over decades is very different from the dollar collapsing. Position for the long-term trend, not the short-term narrative. The dollar is not dying, but the system that made it untouchable, the petrodollar, the Bretton Woods legacy, the exorbitant privilege, is slowly being renegotiated by the rest of the world. This shift will take decades, but the direction is clear, and the investors who understand it early will be positioned for a world that most people are not yet pricing in. If you want the complete framework for protecting and growing your portfolio in a changing global order, check out my investing masterclass, link in the description.